We have a great question here from Alexander asking, what exactly do we mean by pro-cyclical currencies? He's been hearing us use that word a lot, and he just wants a little bit more clarity on that topic. So thanks for the question. When we refer to something like a currency or any asset really as being pro-cyclical, we are referring to how that particular asset is expected to perform during various stages of the business cycle. Now, if we take a look here at a classic or typical sine curve of the business cycle, you will see some popular patterns that you have most probably have seen or heard of before. You have the typical recovery or expansion phase, also known as the boom phase. Then you normally go through a peak pattern. After the peak, you normally see a early contraction. Then you see a full contraction, a recession, which can sometimes lead to a depression. Then you see the economy troughing out, reaching a trough, and then from a trough, you normally enter into, once again, a early recovery, a middle recovery, an expansion, a boom cycle, then you're going back into a peak, etc. So you have that cyclical pattern of any economy, but also the global economy. And these sine curves, as part of classic business cycle theory, is really what drives asset prices, and some of them tend to perform in certain ways in certain parts of that business cycle. Now, when we refer to something as being pro-cyclical, it means that the particular asset is positively correlated with the overall health of the economy. So when the business cycle has hit rock bottom and is starting to recover, as it goes through that early recovery, middle recovery, late recovery, that expansion, that boom, that's normally a very good cycle, a very good part of the business cycle for pro-cyclical assets. And similarly, if we start to peak, if we start to roll over in the business cycle and we go into early contraction, moving lower, possibly into recession, possibly into depression, that is normally negative for your pro-cyclicals. Now, of course, any business cycle, it will vary in terms of the size of the contraction, the size of the expansions or the recoveries, etc. So the performance will, of course, vary on the back of that. But for pro-cyclical assets, they usually outperform when we see the economy, when we have good times in the economy, when we're going through an expansion phase, and they usually underperform when we see bad times in the economy. They also tend to be more correlated, of course, with the overall risk appetite among investors, and they will fall in line with the business cycle. Because if the economy is, let's say, coming out of a recession or a depression, and investors think that the recovery has started or is imminent, they will rotate into more higher yielding, into more riskier assets, and pro-cyclical assets are, of course, a favorite during these types of environments. It is important to realize that, of course, the market is forward-looking, so they're not going to start buying, pro-cyclicals once a recovery is in full force, when it's obvious for everybody that we're there. You'll often hear investors talk about certain pro-cyclical assets as the best time to buy a pro-cyclical asset is in deep recession, because that's really the cheapest that you're going to get those types of assets before you see the curve or the trough and you see that early recovery. Now, of course, there is risks to that because you never really know how far something will go down, but that's normally seen as the best time to buy. If you take a look at something like the Aussie dollar, which is a pro-cyclical currency, and you'll normally hear investors talk about that as being the best buy. It's a deep recession buy, because when everything is at its worst and you start to see that trough in the economy, that's normally the very cheapest spot that you'll get to buy something like a pro-cyclical like the Aussie. So in this illustration that we have from intermarket.com, it shows how certain asset classes might be expected to perform during certain parts of the business cycle. Now, what you'll notice is that both equities and commodities tend to do really well as the cycle turns from contraction into early expansion, middle expansion, late expansion, etc. They tend to do really well, or the best really, in that very first part as we go into early expansion. And what you'll notice as well is that things tend to see a lot of growth during these times. Things like commodities, especially things like copper and oil, because as the economy, if you're just coming out of a recession, as the economy starts to recover, That will obviously lead to bigger infrastructure spending, more investment. It'll lead to more demand for things like copper, things like iron ore. If the recovery, is in that early expansion phase, there will be anticipation of increased demand for travel, which is obviously good for oil. So it's really an obvious time for things like commodities to do really well. Now, even though equities as a whole do perform well during these early stages, there are, of course, certain sectors that will underperform and overperform based on various parts of the business cycle. So when we are coming off the peak, basically, and we're going into early contraction. So if we're at the peak and we're starting to roll over, going into early contraction periods, you normally see things like utility sector doing really well alongside things like growth stocks, because as things start to really go down, as the economy starts to roll over, they normally rotate into things like growth stocks, because they're usually going to be your stronger companies with strong fundamentals, stronger cash flow, stronger balance sheets, etc. And what can also do really well when you're going through that contractionary phase is things like the housing market, because remember, if there's expectations of contraction, there will be expectations of interest rates that's going to be cut, and that's normally good for housing. When interest rates are low, people want to buy houses, of course. And during these environments, that's really bad for things like industrials, bad for things like financials, bad for things like materials. They normally take a real beating when we're going through that contraction and recession and possibly depression phase. So the opposite side of the coin is also true, of course. As we move into that early recovery phase, once again, we tend to see things like utilities doing really bad. They start to underperform. And that's when we go through that early stage, when the market thinks that, we're out of the worst part, we're going into recovery. That's when you start to see things like financials, industrials, materials start to really outperform. And when it comes to your major currencies, your Aussie, your Kiwi, your CAD are seen as pro-cyclical, alongside, of course, your more emerging market currencies. That's more closely tied to things like commodities. So because the commodities as an asset class is expected to do really well in that early part of the expansion, we normally tend to see the currencies that's linked to those commodities also doing really well. So also following that same pro-cyclical pattern that basically follows the overall business cycle. So I hope that explains what we mean by pro-cyclical. Alexander, any other questions, please don't hesitate to let us know.